So let's talk about volatility and how to trade it. We're going to start with volatility indexes, and I'll talk about volatilities on individual tickers at another time, probably in videos where I talk about going short and short spreads on things. Volatility essentially describes the expected move of an underlying. It's what the markets are anticipating happening. It's a little different than your everyday volatility. You want a detailed definition of like how it's quantified, go ahead and ask me in the chat, and I can do that in another video and we can look at it more closely. There are a variety of volatility indexes you might want to look at. You're likely to only ever trade VIX. I mean, that's what most people are interested in, and that's the most easily accessible one. We'll talk a little bit later about why we care about these. Right now, let's look at some of the products. VIX is essentially what the market anticipates the S&P 500 doing, and it's based off of the options, outstanding options there. Other indicators might be like the OVX crude oil indicator, which you might use if you're trading oil futures, but you don't trade it directly. There's ones for currencies and the Dow Jones and even the Qs. And when you're trading on the VIX, you can also trade the tickers UVXY and SVXY. UVXY is a slightly leveraged VIX product, and SVXY is a slightly delevered short VIX products. So why do we care about these, and how can you profit from them? It boils down to two main words, and that is mean reversion. These things return to their mean. And it's weird that we're talking about averages and means in stocks or any kind of trading implement, because things like the S&P 500 don't have a mean. They have a trend line they follow, and the trend line changes over time. But these do have a mean, and I'll show you what I'm talking about using VIX and OVX. The VIX describes the expected move in the S&P 500 and has a mean of 20 and a median of 18. This is since the 1990s. Now, what that means is that it spends most of its days at 18. And some major events will drive it up, which raises the mean, but it does not spend a lot of time above 18. And what that means is you might look at taking a bearish position when it's above that as sort of a hedge. OVX, like the VIX, but for oil, its mean is 36 plus or minus 16, so it varies a lot more. And it too frequently returns to the mean. The purple lines on this are the 200 weekly moving average. Now, both of these products return to roughly these averages, which makes them interesting to trade. Now, you can't buy shares of VIX, so you're stuck with futures and options. You don't diamond hand these. You have to use good timing and your knowledge of mean reversion and how these behave to help you. I take a bearish position when VIX exceeds 35, and I'll take a theta positive bullish position when it returns to its mean. And this is what I mean. I'm long call debit spreads, so it costs me a debit to get into the trade, but my theta is about $5 a day on this spread. So it's not a negative. I'm not losing $5 a day. If this trades sideways, which it often does, for a time, I will receive $5 a day in theta decay per spread. When the theta gets lower on this type of trade, I just roll it out. And if the VIX goes up, I'm positive delta, so I profit more. Now, traders who sell a lot of options may look to other volatility indices to determine their entry and exit point. They also are interested in volatility on individual tickers, and I'll discuss that more in a later video when we discuss IV percentile and IVR. So take a look at these other videos. I think you're going to find them interesting. I've got one on the Greeks here and another one that YouTube thinks you'll like. Thank you. Bye.